Good afternoon, everybody, and welcome to our Calm COVID Convos. I'm joined again today by Rebecca Mahalik, Director of Business Depot Sydney. Hi, Beck.
Hi, John.
And today we're going to hone in, we're going to get detailed on you all around JobKeeper payments. And in particular, we're going to dive into the alternative tests that were finally released. I think it was Friday morning. We got the detail around the alternative tests. So we're going to dive into those, share some of the information about them for you to consider whether they might help you in your position to apply the JobKeeper payments. Now, as always, there's a lot of detail. There's a lot of criteria for these alternative tests. So it's really important that you do apply and get advice for your own specific circumstances, just in case there is something that would preclude you or change your situation. So the idea of our Calm COVID Convos is obviously just to take all the stress, the hype and the drama out of these discussions of everything connected to COVID. We're getting more and more excited about changing the conversation to the opportunities and the positive things that will come out of this and on the other side of this. But we still need to cover off on some of these details because for some of the clients that we're advising, getting access to these JobKeeper payments is massive. And the amount of difference it can make to get you through these next couple of months is huge. So we've got to make sure we're doing everything we possibly can. Now, Rebecca, maybe just remind us of, remind us of the timing. Because they made a couple of changes about the important deadlines to apply for JobKeeper. Where are we at now?
So they've extended the original application timeframe, which is where you've got to go onto either the tax agent portal or the business portal to register your intention to claim. They've extended that out to the end of May now, so the 30th of May, but you still need to make all payments. If you want to claim from the first period, which starts the 30th of March, you still have to make all of the $1,500 payments to your employees by the 30th of April. That hasn't changed. You just have a little bit longer now to register.
Yeah, so if you've made all your $1,500 payments to appropriate people, you effectively got another month now to register, don't you?
That's right.
Which didn't stop me working all weekend because I'm still trying to work out who's eligible and whether they've paid the $1,500 or not.
That's right. It's not really that much of a win.
Yeah, well, I suppose unless you know that the employees you want to apply it for, you have definitely paid the $1,500 already. Of course, we're not quite sure on the timing of payments if you don't register by the 30th of April, in that maybe it'll take some more time to get that payment back to you. Set the scene for us a little bit more, Rebecca, as well. Just remind us at a very high level, what is the basic premise, the basic tests for JobKeeper?
So the basic tests are the ones that we've known for almost 2 weeks now. So actually a little bit longer. It's for most of the attendees on this, it's going to be a 30% decline in revenue. And it's based on comparison periods. We've got 3 periods you can compare under the basic test. So that's March this year to March last year. You would have to see a 30% decline in revenue, or April this year versus April last year, or the quarter April to June this year versus April to June last year. And when you're doing your comparison, you have to use the same methodology to your accounting. And when I'm talking about that, I mean cash versus accrual basis for your revenue.
So if you're registered for cash on your BAS, you can actually choose to apply accruals basis to take out some of the bumps, I suppose, in your invoicing and your receipting. I suppose one more thing to just...
Sorry, you would have to use either cash or accruals in both this period and your comparison period. You can't say use accruals now, but cash last year.
And of course, if you don't meet the requirements in March, you don't meet the requirements in April, and you don't meet the requirements in the April to June quarter, you can still project to meet the requirements from, say, May or, say, June as an individual month, in which case you would only then be entitled to the payments from that month forward. I think there's still been some confusion out there about that. So essentially, the big ticket item, ignoring all the other tick the boxes, get the forms done and those types of things, you've got to show a projected 30% drop in turnover. Mm-hmm. So the Commissioner knew there'd be some situations where the comparison period, so the month or the quarter you were comparing to last year, they knew there'd be some situations where that comparison period is not actually comparable because something significant has happened within that business or within that entity. And so that is why we now have our alternative tests. Basically, think of it as a permission to use a different comparison turnover figure than your last year actual figure. Is that how you'd explain it, Rebecca? Anything to add to that?
No, I think that's a good sentence, John.
So we're still comparing a 30% drop. It's just, what are you comparing it to? Maybe you can't compare it to this time last year. We need to compare it to this alternative calculation. Now, interestingly, one thing I noticed a change on the ATO website, I only noticed this one last night actually, because one of the other things we've always been talking about was we knew these alternative tests were coming, but we also knew within the original rules and explanatory memorandum that there was going to be an opportunity for the tax office to give their discretion. Now, I can see in the wording on the website now that the Commission has actually gone to the extent of saying they will not be given discretion on an individual situation. So the words on the website read, the Commissioner can only determine a test for a class of entities and cannot make discretionary decisions for individual entities. So it sounds like the only way they are going to introduce new rules is through this class of entities by these alternative tests. Now, one more thing I want to absolutely emphasise for everybody is that the alternative tests only become relevant if you don't meet the basic tests. You do not need to consider the alternative tests if you already meet the basic test. There's no requirement to apply the same methodology, the alternative methodology, if you already meet the basic test. If you then maybe fit into a couple of categories for the alternative tests, you can choose which one you wish to rely on. So if you fit in, I don't know, new business and you fit in significant growth, then you can choose which one you want to apply to. You don't have to meet both. You can choose one and just choose to apply on that. Okay, so obviously we've got some of this detail on the blog, but obviously we want to talk through it again now to summarise the situations where we see that we will be able to help you get access. So Rebecca, what are the, I suppose, the high level 7 circumstances where we can get these tests?
Yeah, there's 7 scenarios, or they're called the 7 tests. The first one, which you already mentioned, was around new business. So if you've got a new business that commenced during the comparison period, so if you wanted to look at March as your decline or April, but your business did not start in March or April last year, that's one of the tests. Any businesses that were acquired or disposed of during the period, so effectively the last 12 months. If you had a restructure inside your business that's affecting your ability to claim under the basic test. If you experience substantial growth in turnover during the comparison period, which means that your drop in revenue is hard to claim under the basic test. If you are affected by drought or natural disaster, if you have irregular turnover, or if you're a sole trader or a partnership and you're suffering from sickness, injury, or leave circumstances. So they've really come out and addressed a lot of the areas that people were questioning and those more unusual, out of the ordinary circumstances for businesses in Australia.
Yeah, and then the main ones in there, there's probably the majority of them are really about the number last year is not a meaningful comparison to the number you have as your actual result or projected result this year.
That's right.
So let's dive into each of these. Now, we're going to try and keep this as simple as we possibly can. We'll take questions as we go on it. But the way we'll have this conversation is there is essentially when can this alternative test apply? That's the first part. And the second part is when it applies, what's the comparison turnover that you can then subsequently use? So can you kick us off, Rebecca? Tell us about the new business alternative test.
Yeah, so the new business test applies if you started a new business before 1st of March. So if you've started it since 1st of March, you're still not included in this. You needed to have started your business before the 1st of March, but your drop in revenue you experience in your comparison period, there is no month to compare that to last year because you started your business after. So what I mean by that is if your drop in revenue is say in the month of April, but your business only started in October, so you can't compare it to April, this test applies to you. And then the way that you will now calculate out your revenue to determine whether or not you've had a 30% drop is going to be an average of the trading months from when you opened to the month just before your comparison period. So if you are going to compare April and your business started in October, you're going to look at the months between October to March, determine your average revenue, and then if there is a 30% drop on that average revenue, then you will be eligible for the JobKeeper under the new business test.
And I think it's important to highlight there, it's the average of the whole month since you operated. So if you started halfway through a month, you only start looking at the turnover in the following whole month.
That's right.
I believe there's a second alternative one that you can choose to apply as well with this test, Rebecca.
Yeah, it's if you've only been trading for 3 months. So the average of, so what you can do is the average of the last 3 months, provided you've been trading for at least 3 months. So this is for businesses that have started, I believe, since 1st of January.
Yeah, I think you can actually choose to apply this even if you started a bit earlier, Rebecca.
Okay.
But I think it's on the basis that if you started business in, say, October, maybe you didn't get a lot of traction in the first couple of months. And therefore, the last 3 months, being the January to March, if you're applying April, you can choose to do the 3-month average as well.
That's right.
What happens if I started in February?
If you started after the 31st of January, the comparison period is actually based on the month of February divided by the number of days. Remember, this year it was 29 days in February 2020, not 28. And they'll be looking at then what your average daily revenue is, or the replacement comparison will be based on just February divided by the number of days of trading, and then you pro rata it for the full month. So say if you started on the 3rd of February, you would then have to average it out. So it becomes a little bit of a complicated calculation to explain over video, but there's a calculation on our website we can go through.
I mean, really, the comparison turnover or the replacement comparison turnover is pretty much a common sense sort of thing, isn't it? If you start a business in a month, it's the average which becomes your new test. Importantly, or one of the biggest questions I think on this one is, when does someone actually start or commence a business? Because I know the ATO specifically has highlighted that an entity can exist before the business is commenced. And so you might form a company on the 1st of July last year, but not, I don't open the doors, to use that analogy, until September. So that commencement date could become really, really important as well.
That's right. And then with the first part of that test, what we've already mentioned, it's not just the commencement date, it's the first full month of trading. So even if you commenced in the middle of the month, look at the beginning of the next month.
Yep. Now, the second test is the test where you've acquired or disposed of a business or part of a business. So probably a great example to think about here is if you had 2 divisions in your business and you sold one division of your business off to somebody else, which meant if you were comparing your turnover to last year, you would have 2 divisions worth of turnover within there rather than the division that you just have now. So the test will apply when there is any acquisition or disposal or part of the business after the relevant comparison period. So the same thing, if we're testing April, then it would need to be after April 2019 that you've done something in that regard. There's one other key criteria in this test, and it's just another little subline in there, in that the acquisition or disposal had to actually result in a change in your turnover. So you can't be selling something and it doesn't change your turnover. That will not be sufficient to enable you to apply this test. No real idea on how big a portion of your business you have to be acquiring or disposing. There's no sort of indication within any of the stuff I've read. You haven't seen anything, have you, Rebecca?
No, I haven't, not yet.
Yeah. So, I don't see any sort of guidance on whether it's a significant part, but obviously if it's a significant part that you're acquiring or disposing, then that's just going to have a bigger impact on the comparison figure for you. The next one, Rebecca, that was around business restructures. Do you want to take us through that?
Yeah, so with business restructuring, probably one of the most common things that you would be looking at or that jumps to mind is going to be something like a merger. Again, the important part here is that this merger actually changes your business and your revenue, that there is a significant change to be able to apply the alternative test. It's very similar in the application to the two tests we've already discussed, that if you had a merger in the period, so if you're looking at April as being your downturn month, for example, and you'd had a merger since 30th of April last year, so your comparison doesn't really line up appropriately, then again, you're going to look at those, the average of the month's turnover since the restructure occurred. And if your turnover in your comparison period has dropped more than 30% to the average up to the month before your comparison period, then you'll be able to apply this test. So there's some real consistency in particularly these first three tests in the way that it applies. It's all around that average, calculating out your average revenue since the business really changed.
And they're pretty much common sense, aren't they?
That's right, yeah.
Yeah. Interestingly, on the business restructure, sometimes people will restructure for asset protection purposes, or they might be wanting to move a division into another entity for some reason, some of that sort of stuff. That brings about this sort of shared services sort of way of thinking sometimes as well. And I understand Treasurer came out on Friday saying there's likely to be another alternative test to take into account these service entity sort of style arrangements where you have all your wages in one entity and you on-charge your wages to the entities that actually carry on the services. So we'll have to watch this space on that one.
Yeah.
The fourth one is one I find really interesting, and I know we've applied a lot with our clients already, and that's, let's just call that the substantial growth business. Now, this is where you're a business that's on a pretty high growth curve, and as a result of that, the business you're in today is very different to the business you were in last year. Maybe you've increased the number of employees, maybe you've increased locations, but you've shown a substantial amount of growth throughout the year. So this would apply to startups, but there's a lot of other businesses that this can potentially apply to as well. And I think it's probably going to be the most common one of the alternative tests to be applied. Now, there's three criteria to assess whether you can apply this alternative test or not. The first is, in the last 12 months, your turnover's grown by 50%. In the last 6 months, your turnover's grown by 25%, or in the last 3 months, turnover's grown by 12.5%. So I think, and when I say the last 12 months, 6 months, or 3 months, that is the period just before the test period. So if you're applying it to the April quarter, then it is 12 months of growth up to March, or 6 months of growth up to March, or 3 months of growth up to March, being the period immediately before your test period. Irrespective of whether you meet the 50%, 25%, or 12.5% criteria, the comparison turnover figure you then use will be the average of the 3 months immediately prior to the test period. So again, if you're applying April or the April to June quarter, then it would be the average of the January to March period that becomes your comparison. So you would then have to show a drop of 30% on that quarter or that average monthly turnover. I'm actually working through this. I think there's actually there could be, I suppose, a few people who maybe accidentally fall into this category for a number of reasons. Maybe, some industries that traditionally have a quiet sort of Christmas or something or other, or maybe a quiet start to the year would probably be an example, or have come off some poor periods previously. But startups is the other main one that's covered off. And it's interesting to note that they've actually picked, even for the last 3 months growth, the figures that they've picked are quite high. So they are looking at very high growth businesses, like a 50% growth in revenue in 1 year, or a 25% for 6 months. They're big numbers. So they've been quite specific about that. So the next one, Rebecca, businesses affected by the drought. That's an easy one. Do you want to take us through that one?
It's an easy but distressing one, John.
Yes.
Yes. So if your business has been unfortunately affected by the drought or other natural disasters, which means that comparing your income this year to last year isn't appropriate, because potentially you actually have done better this year versus last year because last year you were in drought. For example, you're able to then, instead of using last year's figures in your comparison, is actually use the figures from the year that occurred the year before the natural disaster event happened. So if you were in drought in 2019, but were not in 2018, you would use, and you're looking at March this year as your drop in revenue, you would compare March 2020 to March 2018 when assessing the decline in revenue. You just need to be looking at what year that natural disaster occurred in.
Yeah, because interesting, there's some other exclusions throughout most of these alternative tests where you can automatically, or you are required to automatically exclude the comparison period where there was a month or a drought declared sort of situation. Obviously, what they're getting at there is they would expect that their business already suffered a downturn in the previous year because of the bushfire or the drought in that situation. So they're requiring you to, or allowing you to take that out.
That's right.
Okay. The next one is around irregular turnover. So I find this one a bit of an interesting one as well. A slightly different methodology to determine whether you are eligible or not. So I'm trying to think of the types of businesses that this might impact. But what they require you to do is they require you to look at the last 12 months, but look at it on a quarterly basis. And so you got to work out what your turnover is for the 4 quarters of the last 12 months prior to the test period. And you then need to be able to see whether your lowest quarter is 50% down or more than your highest quarter. So basically they're trying to identify a criteria that says you are a very irregular turnover business, and because of that you have big disparity between your lowest quarter and your highest quarter. There's one other criteria though which they've specifically put in for this test, and it's just worded that your turnover cannot be cyclical. So I assume that means seasonal or naturally always on a certain cycle. Interestingly, that cyclical sort of word has only been applied to this alternative test around irregular income. If you are in the substantial growth criteria, then there is no requirement in the rules for you to apply this cyclical sort of extra test, but there is in this irregular turnover. So if you fit this category of irregular turnover, you then use the 12-month average turnover for each whole month immediately before the test period. So again, makes sense. You're using the average that irons out the lumps and bumps throughout the year. And obviously you can divide that by 3 if you're doing a month test, or apply it to a quarter test if that's the period you're looking at.
Yeah, the kinds of businesses this might apply to is going to be your big project businesses. So maybe a construction business or an organisation that has big projects. It's not cyclical. It's not based on the seasons or certain projects every couple of years that occur or every few quarters, but something that you really don't have huge amounts of control over the start and finish and big payments of that project. And there could be, 1 month where you receive lots of income and other months where you receive virtually none, and that doesn't follow a pattern from year to year.
So you're thinking about like construction businesses or something maybe?
I think construction's key for this one.
Yeah. I'm just trying to think of the situation where you don't meet the basic test. So it has to be that your comparison figure for the previous year was maybe low because of a project hadn't been finished or something or other. Whereas when you iron out the lumps and bumps of the 12 month, it might meet that criteria.
Yeah.
And the 7th one, Rebecca?
So this is the last test, and it was something that was originally almost specifically excluded in the first round of tests, and it's around sole traders and small partnerships that have sickness, injury, or leave. So this happens if when you're a sole trader or a small partnership, there's normally only 1 or 2 people who are actually working in the business. And if they weren't working for the whole period of the year that's in the comparison period because they were sick or had an injury or on leave, which affects the turnover. So that when you're looking at your comparison periods, that turnover period that you need to compare to might have been really low for one of these reasons. So what they're allowing you to do now is to use the month immediately prior to the injury or the leave as your comparison period instead of using the actual period.
Immediately after, I think it is, Rebecca.
Right, immediately after, not before. And then and if you're looking at it for a quarter, you take that month and multiply it by 3.
Yeah.
So it's just trying to find, letting you compare to real results instead of results under extraordinary circumstances.
Yeah. Okay, let's dive into some of the questions before we make a few extra comments. Julia's got a question. So if we acquired an extra office in July, then we compare the monthly average July to March with April, or the 3 quarters. Okay, that's correct. If you want to test under this alternative test, so that would be under the business acquired or disposed test. And that is exactly right. So you could choose to calculate the average since that acquisition, or you could choose, given that's the one where, no, it's not, it's the first one. So yeah, you'd be comparing to the average since the acquisition to determine whether you've had a 30% drop or not. Hopefully that answers your question. Margie's got a question. New business test example started in January and had to close during March due to COVID-19. Does the business compare the monthly average from January to March against April?
Well, this is going to come down to what we were saying about knowing that start of your business date, but then understanding where it falls in the month. So if you started your business in January and say it was the 15th of January, we need to look at full trading month. So you're actually going to be looking at from 1st of February, and then that would be the beginning of the average. So if you're looking at, I think you wanted to compare it against April, you're going to only have an average of the February and March months as your comparison period.
Yeah, but if you started before January, then yes, correct. Your January to March average compared to April will be a test that you could apply under that one now.
Yeah.
Okay. Got any questions on there, Rebecca, you want to?
We've got a question here around the growth test, which we mentioned percentages as 50%, 25, and 12.5 growth rate. What will be the base year or period on which this growth percentage is calculated? So what I understand of that is actually in the last 12 months before the test month or test period that you're looking at.
Yeah, so obviously we don't have too many examples, or I don't think we've got any examples actually on the explanatory memorandum or in the tax office guidance about this. But when I read the legislation and I applied this over the weekend, if I was testing April, I did a comparison of March 2020 to March 2019. I then did a comparison for the 6-month test of September 2019 and March 2020. Did I do that right? Yes, I did. And then I did December to March. So it all has to back up to the month before the test period or the quarter before the test period, depending on which one you are applying. Esti's got a question. Hi, Esti. For the growth in turnover test, is the growth measured by turnover at start of period versus at end? Example, 12-month option for test period for April would look at whether the March month turnover was at least 50% of March 2020. That is correct. So I think I just answered that one in my previous answer there as well. Jacqueline's got a question in the chat there. We acquired a second rent roll and used it to open a second real estate office. So depending on your entity structure, Jacqueline, you might need to, if they're in separate entities, then you probably need to apply the test separately. But if they're in one entity, you might be able to apply the businesses acquired or disposed test because you're acquiring a new part of your business. So that would then enable you to have a higher comparison period because you'd have the period after you acquired that second rent roll. If anyone does have any other questions, please jump on the Q&A there. I know this topic's a fairly detailed sort of topic for us to get into. So Luke's got a question. Hi, Luke. If I started my business in April 2020, do I just miss out? Yes, you do. So you had to, you had to have employees at the 1st of March to start with. So anyone who started a business after the 1st of March will not have any access to JobKeeper payments, as I understand it at the moment.
That's actually the date I believe that they've put into the first test. Is the new business must have started before the 1st of March as well. So yeah, unfortunately, you just miss out.
Yeah, of course, there could be a whole discussion around when did you commence business, which that could go down a rabbit warren, but something to think about. I think there's a couple of other little questions on there. They're not necessarily alternative test related. Any of those you want to answer?
We've got a question here from Alex. How do we select which testing criteria we are using when applying? Now, you don't have to use multiple tests. If you pass under one, you use the most appropriate test that allows you to access the JobKeeper. If another test results in you not being able to, you don't have to worry about considering that. Just consider the test that applies to your situation that can help you result in being eligible for the JobKeeper payments.
Yeah, yeah. Robert's got a real estate office question on there around the lag effect with regards to sales and commissions actually paid. Where would we be in regards to those 7 new options? So you still got to have comparable accounting methods to be able to compare your current figure to the previous period. So I know there's a lot of conjecture within the industry as to whether you should be accounting for your income on a written sales, unconditional sales, or settled sales. I would suggest that you need to, as long as you make it comparable to what you accounted for in the previous year. And it's quite an interesting outcome when you apply some of these tests to real estate businesses. And it's worthwhile looking at, in particular, the growth one to have a bit of a look at. But the lag effect, most real estate businesses are still having pretty good settlements in the month of April. So therefore you need to look at the June quarter to see whether the June quarter would be down by 30%. If not, you may not qualify until say May or June if you account on a settled basis. Got another one there for us, Rebecca?
We've got one last, oh no, we've got a couple more. Sorry, I missed those. So we've got alternative test here from Angela, March 20 and 6 months. So you were saying that you compare September 19 income to March 20, and if there is a 25% increase, then we would satisfy.
That satisfies you to apply the test.
Yes.
You then have to calculate the average turnover for that 6 months. Oh no, 3 months.
No,
Sorry, so
3 months. Yeah.
So the 25%, you meet the 25% test, that means you can apply that alternative test. You then have to work out your comparable turnover, which is the average of the 3 months preceding your test period, and you have to show a 30% drop on that comparison. Did I rubbish that one up, Rebecca?
It's okay. Got it in the end.
There's a lawyer, so math scares him. Increased turnover using March 2020 as same test. Using 3 months, December to February, is it simply that Feb 20 turnover is at least 12.5% more than December 19? To qualify to apply that test, yes, but then you have to work out your average turnover for those 3 months, apply that to your March, and see whether March is 30% down on that period.
Got it in one that time, John.
Getting better at this. Maybe just cover off on these simple questions here, not quite alternative related, but Margie Purcell, what pay week should be the first one to claim? So the first pay week is from the 30th of March. That's when the JobKeeper fortnights kick in. Lyndall, I think that's about a PSI question. You got any comments on that one, Rebecca?
What it looks like to me is they wanted to get some clarity over whether or not Test 7, which is for sole traders and partnerships, can apply to companies when there's just one director who is the only person who works in the company. At this stage, no, it also doesn't apply to trusts.
Yeah, it's specifically for sole traders and for small partnerships at the moment.
That's right.
I did have a question that was emailed to me before as well. So Adam had a question. I've done a series of acquisitions over the last 12 months and have a rising plane of income as the various new income streams come on board. My income is down due to COVID-19 from where it should be, but the total income is still higher as the downturn is masked by the general upsurge from the acquisitions. So that's a prime example of where you should have a look at when you made your last acquisition and look at your income after that acquisition to reset your comparison turnover to determine whether it's now dropped off by 30%. So hopefully that's answered your question there, Adam. Heather had a question, which I sent by email. Ooh. I don't know if I've seen that one yet. Let me have a bit of a look.
Heather, do you mind just popping that question again in the chat if you've got a sec?
Found it, Heather. Okay, so question one, Bob is a semi-retired director in a real estate agency. He does not work in the office on a daily basis, nor does he draw a wage. As a retired director, he maintains an active interest in the business by joining younger sales reps, accompanying PMs and out-of-town routine inspections. He shares the annual net profit. Would he classify as actively involved? Well, the terminology is actually actively engaged. So the question is around self-employed people that work through a business. They can claim as a business eligible business participant, claim it for themselves, for the entity, if they are actively engaged. We were talking about this before, Rebecca, weren't we? We still don't have a lot of clarity on this definition of actively engaged. I don't know what you're sort of saying to people, but I'm sort of reverting to a bit of, well, are they really actually working in the business on a reasonable basis? How else are you looking at it, Rebecca?
Yeah, I'm looking at, when we're looking at the actively engaged as well, it's generally business owners that are the people who are looking at actively engaged. So are they running that business? Are they involved in the decision making? Are they involved in the operations? Do they turn up to work if there is a physical site? It's these sorts of, fuzzy things that we need to be looking at, unfortunately, when applying the test, and just seeing how involved they are in the day-to-day. I don't think that someone who sort of drops in once a fortnight, puts in their 2 bobs and wanders off is really actively engaged.
Yeah, we might have to go back to some Oxford definitions or something or other, or if there's any case law on actively engaged and those types of things, but we haven't been given any indication as to whether they work, I don't know, a day a week or anything like that, as far as I can understand. Happy to have a discussion offline with you about that one, Heather, if you'd like to. The second part of Heather's question was, would the same apply if we were a partner and not a director? The same applies. You still need to be actively engaged to get that as an eligible business participant.
That's right.
A couple more questions popped up there. If you predict the June quarter to be a 30% decline, do we claim April, May and June? Correct. If you're 30% down for the June quarter, you can claim it now, provided you've met the other eligible requirements like the nomination forms, you've done the single touch payroll and you've paid the minimum $1,500, then yes, you can claim it now.
Yeah. I've got another question that looks like it's around this active engagement. So if a person is a director of a company and paid by PAYG, how would they tell if the arrangement is casual or not? They're not accruing annual leave or sick leave, paid a flat rate regardless of the hours per month. It's actually
that might be like a director fee sort of, or like a board position or something.
Yeah, and it might actually also come down to whether or not these PAYG payments, because it looks like that they're taking it through wages, are being reported under single touch payroll as well. My understanding is if you're there and you're on single touch payroll and you're getting paid, you're going to be an included employee.
I wonder whether the question then gets to whether if they are considered casual in nature, whether they have been with them for 12 months or not, as compared to say a permanent part-time type position.
Okay, it's a board.
Yeah, and I think the follow-on sort of comment there sort of highlights that, if it's paid as a PAYG, because you're excluded from claiming as an eligible business participant in your own entity if you got a PAYG from somewhere else. That's right, isn't it, Rebecca?
That's right.
Yeah. There might be a bit of a tricky one, that one, Claire, unfortunately. Again, happy to have a discussion offline with that one if you like. Okay, very good. Look, hopefully we've answered a few of the questions there for you. As I said right at the beginning, there is a lot of detail in this and you really do need to look at your own particular circumstances. The old simple comparison of one period to another just got a lot more complicated with 7 more alternative tests, and the bags under my eyes can vouch for that, given the tests we were applying over the weekend for clients and so forth. I think the next one to really watch out for is any alternative tests for service entities. So if anyone who has their staff, for example, in one entity different to the entity that provides the services. And they did come out with some clarity as well around this one in, all in approach, in that they are insisting that you have to offer JobKeeper to all of your employees. It's only your employees that can opt out on their nomination form, saying that they are not participating. They also had a bit of clarity around students, 16 and 17-year-old students. They've sort of made it clear now that the rules will provide that full-time students who are 17 years old and younger and who are not financially independent are not eligible for the JobKeeper payment. So if you've got a full-time student, 16 or 17, we don't have to top them up if they're not financially independent to the $1,500.
Correct.
I think that was to probably help the hospitality industry out a little bit, given the amount of casual students that they employ.
That's right.
Guys, I hope that's been of some value to run through in a bit more detail the alternative tests. Again, look at your own particular situation. Rebecca and I and all the teams at Business Depot would be happy to help you out and give you some formal advice on the application of these tests for your particular circumstances. So if you'd like some help, please don't hesitate to reach out to us. Phone number 1300B-DEPOT, or reach out on email oneplace@businessdepot.com.au, or of course reach out to Rebecca or myself direct. Our details are all on the website. Any final words of advice, Rebecca?
Again, throughout this whole series where we've focused on just stay calm, think about it logically. All the tests come down to logic. Has your business suffered a decline? Well, let's see how we can look at whether or not that's been 30% and just go through it one step at a time.
Yeah, I'm seeing a lot of conversations out there on social media and stuff, which are almost overcomplicating it a little bit, I think. And then I think people are looking for things that they're going to get caught on. I think the government and the tax office has very clearly made their position. They want to pay these amounts to people, and they're not putting these hooks in there to trap people. So I think don't stress and don't overcomplicate it as well. Guys, keep an eye out for any new updates. If there's any more information comes online, if you're obviously on our mailing list, so we'll have them out on email. But of course, you can also check out our blog, the main blog, the shortened URL, bit.ly/BD COVID updates. The JobKeeper one is sort of in there as a link.